What's up guys, John here. In this video I'm going to talk about Jeff Bezos and Amazon and their spree of acquisitions. I'm not talking about Jeff Bezos' new $165 million mega mansion in Beverly Hills or the house he just bought next door to that for $10 million. Not talking about a bunch of apartment buildings or land or condos. I'm talking about this one specific segment of real estate that no one talks about, yet a ton of private equity companies are running out there trying to beat Amazon to the punch. It's going to get really interesting over these coming few years, and I'm here to report to you guys and share with you exactly what's happening and where I see prices in this specific real estate segment. So smash that like button, drop your comments below. If you're a new subscriber, let me know, drop it in the comments. I'll personally welcome you to the channel, and I'm here to give you guys that head start. Hopefully you can get your spot. You can buy that one piece of property, and these competitors are simply going to raise the price to the moon. All right, guys, let's begin. If anyone's benefited from this lockdown, it's Amazon. They are using their short-term gains, which are monstrous, to build out infrastructure to help them scale long-term, because people are creatures of habit. They know that people are going to continue shopping on Amazon every single day. They're getting more and more loyal customers. These new safety precautions are killing brick and mortar retail. Malls in LA are closed. A few weeks ago, it wasn't like that. However, for safety precautions, they needed an employee at the door, and they were paying that employee. The retailer had to pay for that employee, and they're only allowing a set number of people inside of the store. And if you notice, when you go into these stores, you see everything on sale. Why is that? Because their brick and mortar retail space is so expensive. Employees are so expensive. You have utility bills, insurance, and everything else, and it's bankrupting countless companies every single day. Just since this shutdown occurred, we've had some of the biggest names in retail go under. January, we have just one or so bankruptcies. Then February, then March, the month of the overall shutdown. Then April, and then May, and then it starts to really start to unload June, July, and we still have 5 months left of the year. This is going to get very interesting, especially because we're only in the beginning of this safety shutdown. And I believe that in 5 more months, nearly every single retailer is going to go under. And Jeff Bezos and Amazon will be like the modern day John D. Rockefeller and Standard Oil, where they have a monopoly on nearly everything. And this is going to get very interesting to see how they compete in real estate. Because if they take real estate, then they are simply going to continue to expand. Before you know it, everyone will be renting from Amazon. And that just seems like the direction that we're heading right now. An easy way to look at real estate is the more income the asset drives, the more it's going to be worth. So if you look at a Macy's or a JCPenney, those companies have much greater expenses, so they can only pay so much for logistics and warehouses and things of that nature. However, Amazon, their margins are much greater because they don't have those expenses, and they have many third-party sellers. So this benefits them greatly. They can turn product much faster. They can have something come in that warehouse and 30 minutes later leave and head to the customer. So Amazon is in a position to gain much more from that logistic and warehouse center, as well as other e-commerce brands. So this is going to greatly impact asset values in this area. And that being said, this is going to drive even more competition for not just the land, but the roof over their head to contribute to more distribution and products to be spread throughout the country and the world.
Online sales are growing at, call it 15% plus or minus in almost every country in the world.
I'm going to play a clip here of Jonathan Gray, who spearheads the real estate division for Blackstone. He is a very intelligent guy. Purchased 55,000 homes with Blackstone and their investors in the last market crash, and they're getting very aggressive with logistics centers and warehouses.
And as customers get more and more comfortable buying goods online, they tend to buy more and more. Millennials buy more than their parents and grandparents do. All these lead to greater and greater share shift online.
And that's very much true. In 2017, it was mainly millennials doing the buying. However, now the grandparents and parents are forced to adapt out of fear of their own safety and health. So it's forcing them to go online and get used to the new way of doing business. So this is bringing in a whole new demographic of buyers coming to the e-commerce space, which is then greatly going to impact the overall asset values of these properties.
It means vacancies are getting lower. It means rental rates keep getting higher, and that's very good for real estate values in the space.
So that being said, e-commerce brands benefit much more for having this, and they're willing to pay much more because they're gaining much more. So it will increase the overall leases and the income generated from these assets, which is then going to greatly impact the investor's return who buys these properties.
The biggest change we see now is the importance of online retailers getting closer to their underlying customer. A few years ago, they were focused on getting goods to the customers in 2 days. Now they're focused on 2 hours.
You will continue to see a push for last mile space so that we can get goods to people who live in urban areas.
That being said, Amazon's newest expansions, Valencia, California, then they went to Miami-Dade, all urban areas, then Bronx, New York, and then Chicago. They're within close proximity to a majority of their customers in that area. Just makes shipping and distribution that much easier, that much faster. And as they have these 4 locations, they're going to continue to expand to where they can cut that delivery time down to an hour or less.
Warehouses need to compete with apartments, office, and retail. A lot of uses that have much higher values for the land. It's going to keep supply down, and that's very good for values.
So what that means is there's a finite supply of land available. So they are buying these logistic and warehouse centers, these huge plots of land, gigantic. If they want later down the line, they could repurpose that land. They could tear down everything, build brand new apartments. They could turn it into a farm. They could literally do whatever the heck they wanted to on that land because it is so valuable. And over time, it's only going to appreciate as the population continues to grow in America. So they're playing both sides. They're playing the short-term logistics and then long-term, the option of possibly redeveloping the land or selling that property to a developer who has a higher and better use for the property. So it's a very, very smart strategy.
At Blackstone, we started investing in 2010 here in the U.S., put together a portfolio that we sold for over $8 billion. So 2 years later, in 2012, we start buying warehouses or logistics properties in Europe. We become the largest owner of logistics in Europe and Asia as well. We're the owner of warehouses in Australia. We've been building logistics properties in China.
The global economy is being transformed by technology.
Another huge upside of this business model is you do not have to comply with housing regulations. Whether you live in New York City, LA, San Francisco, or even Barcelona, where they're now suggesting that you offer free loans to tenants, essentially rent deferments where they have 12 months to pay you back. And if they don't, then good luck collecting. With a logistics center, a warehouse, where they're buying them in Asia, Europe, America, all over the world. They're buying them in these dense locations where as time comes, it's going to expand. People are going to expand outwards because everyone continues to move as close to the city as they possibly can afford. But over time, it continues to progress and prices follow. So it's just a very smart business model, and I feel over time this is going to do incredibly well. It's almost like Sam Zell's business model, where he bought 144,000 mobile home parks right after the market crashed in 2009, made a 1,400% return, and his plan was to buy these lots, buy these huge trailer parks, and then lease the land to people that want to park their vehicles on top of this lot. Now, the great thing about this is in a recession, people downsize from their house to an apartment, from an apartment to a trailer park. So he has the freedom and flexibility to increase his rents just below the cost of an apartment. So he can kind of ride that trend as rents for apartments increase and he's increasing his. He can put little amenities on the lot and continue to increase rent. And with this logistics center, it's a very, very, very comparable strategy.
The way goods are distributed to consumers is in its early stage of this transformation. Warehouse assets are critical to that. We think this trend will continue, and as a result, we'll continue to invest significant capital both in the U.S. and around the world in logistics.
Amazon spent $9 billion in the second quarter alone with fulfillment centers, transportation, and web services. And this has been a devastating April for Blackstone, who's heavily invested in retail and hotels. They bought Hilton Hotels many years ago. However, they've been riding a wave thanks to Amazon and e-commerce brands. And the only thing stopping them from further expanding is the lack of available land for sale. In addition, Amazon owns Whole Foods, and Whole Foods has done a spectacular job as branding themselves as being the leader in healthy and organic meats and produce. So people are spending extra money to be a part of Whole Foods, to shop there. And they're becoming Prime members, Amazon Prime members, getting on that monthly subscription. Their sales have tripled year over year, and the last 3 months during this lockdown has skyrocketed their business, showing the demand for much much greater infrastructure to be built to support all of the customers that they have in all of these urban areas. That being said, we're going to go through an interesting period with logistics centers and warehouses. They're going to shift from dealing with brick and mortar malls and retail to online distribution. Many of them, they may go bust. Many of them may go for sale. Many of them will hit the market, and when they do, competitors and investors like Amazon, Blackstone, as well as a sea of other different investors are going to seize the opportunity because they see the shift and the change that's happening to real estate in this sector. Real estate laws may also change for multifamily investing in places like New York City and LA and San Francisco and many other democratic states. And this will also force investors to look elsewhere for greater returns. The main issue here, the main issue for new investors to get into this area to invest is that this requires a larger down payment. So a property may be $1 million or $2 million or $3 million, but you have to factor in a 30 or 40% down payment. And that barrier to entry is high for the first deal. So many start out with a 3 or 4 unit property, and they'll buy this property with a 3.5% down or 5% or 10% down loan. And this gets them in the door, and then they start their investing career there, and then they build up and scale over time. So it depends on which stage you're at. However, this area is definitely going to have a long ride of appreciation over the coming decade. Jeff Bezos owns 40 companies below Amazon. He alters your perspective of Amazon through a few of them. He has stakes in Business Insider and Twitter, and he owns Washington Post. He owns the Ring system for home security, among a sea of other investments. And anything that Amazon wants to do, they'll do, and they'll do very well and essentially dominate any competitor in that space. And I believe that they're going to get into residential, multifamily real estate, commercial real estate. Your residential home is where they want to be. Because if they can control the food you eat, your house, security system, and essentially every dollar that hits your pocket may cross through Amazon's hands, I think that's what they're going to want to do. And if this depression or recession gets bad enough, I think they're going to see the real upside in them leveraging their cash on hand into a great asset like commercial real estate. And so how they would do this is they could go buy $1 billion worth of real estate for $250 million. They can leverage their money 4x and take all the tax benefits and continue to scale and grow. And they know the land is only going to appreciate over time. And depending on how bad this recession gets, they may get more and more aggressive. And another beautiful thing about Amazon is that every investor in the world has faith in Amazon. They would be able to raise trillions of dollars if they wanted to. And who knows if that's something that they're going to do, but they do have the capacity to do something like that. That being said, consider what your long-term goal is and build your plan out accordingly. If your plan is to just get your first deal, click the link below. I have a free, completely free real estate investing mini course for new investors. I respond to all comments and questions. If you need anything with any questions about real estate or investing, just drop them below. I will always respond. Thanks so much for watching. Please smash the like button. When you hit the like button, it lets YouTube know that you like the content, and they're more likely to share it with other people. And subscribe. If you're a new subscriber, let me know. I'll also welcome you to the channel. All right, guys, until next time.